NLY, that's Annaly Capital Management, is always a favorite of mine. Good volume, great yield, long track record. Any thoughts on NLY? Well, they are a mortgage REIT, so they're different than the real estate stocks I'm talking about here. Their primary investment is they buy mortgages and mortgage-backed securities, things like that, and collect interest payments and profit from the difference between their cost of capital and what they're paying for mortgages. What I can, I'm not a mortgage REIT investor. I'm not that big of a fan of the business. It's tends to be volatile in tough times, which look back at a chart in March and April, and it'll make the Dow and S&P look pretty tame. Um, but I will say that they are probably the best in breed. They're my favorite mortgage REIT out there, and they thrive on stability. Mortgage REITs do their best business in stable environments. They don't want interest rates to spike higher too quickly. They don't want interest rates to fall too quickly. So if you think this is going to be a pretty stable environment, then it could be a good time to look at mortgage REITs. But I'm generally more of a fan of what they call equity REITs, which are the real estate companies that own actual businesses.
So. Yeah, let me just touch on Annaly one quick second, because I know this trips a lot of people up. I don't know a ton about Annaly. I do know that it always has a double-digit dividend yield. Like, that's like the thing about it. That is really tempting. Super tempting, but you have to look at total return, not just dividend yields. So let's do that. How has Annaly performed versus the S&P 500 over the last 1 year? Lost. 3 years. Lost. 5 years. Lost. 10 years. Lost. It doesn't look like a wealth creation machine to me. It looks like a company that uses share issuance to fund a dividend, and it tricks people into thinking this is a great buy because it has a massive yield. So I know that this is a fan favorite for a lot of people that seek dividends, but if you consider total return, which you should, it has been a loser over the long term.
Yeah, I would definitely agree with that. A lot of the reason, to be fair, is because mortgage rates have generally been on a downtrend over that whole chart that you showed.
Yes.
And
actually, to be super fair, let's back up since time, and it has been a wealth creator. So that's an excellent point. And if you've bought this thing in 1998, hey, you've done really well. But
just look at the volatility. Look at how much the chart jumps around compared to the S&P over time. So it's not a stable income machine. This is not a savings account with a 10% yield.
Yeah, it's just been a bad decade. But that's to me, I want to own things that have beaten the market over the last 5 years. That's just where I look. This thing hasn't.
It might turn
it around. And to Matt's point, which is completely valid, interest rates have been in the zero for the last 12 years, essentially. I don't know if that works against the company or not, but the point is still valid, which is focus on total return, not just dividend yield.
Well, the general idea behind Annaly and all these mortgage REITs, just to kind of give a little bit of the technicals, is the general business model is that they borrow money at cheap short-term interest rates and buy mortgages that have 15 or 30 years, just like mortgages. And generally, the longer term duration your financial instrument, the higher the interest rate it's going to pay. So if they can borrow money at 2% and buy mortgages paying 4%, they get to profit from the difference. Now, what they'll do is they'll borrow a bunch of money and buy a bunch of mortgages and use a lot of leverage to get these 10% yields. So if they have, say, a 5-to-1 leverage ratio, meaning for every dollar that investors put in, they're borrowing $5 and are getting a 2% spread on their mortgages, that's where your 10% yield comes from. The problem is when those short-term borrowing costs jump, you can see these profit margins go away really quickly. And when interest rates fall really fast, you'll see a lot of people prepaying their mortgages, and these mortgage securities that they bought just disappear. So it's a risky business model in the short term. It, like I said, it is not a savings account that has a double-digit yield, but if over the long term, it does have the potential to beat the market. But I wouldn't buy it as, an S&P replacement. It's know exactly what you're getting into, and it's not look at total return, like Brian said, and over the long term, it's done well, but over the recent times, it really hasn't because of all those reasons I just mentioned.
Mm-hmm. And if REITs don't go up, it might be a sensational performer. I don't know it well enough. The point wasn't to say this is a terrible company. The point was to say you can't just look at one metric. you.